Together with the interest rate hike, Federal Reserve officials indicated an aggressive path ahead. They announced at least 6 more rate hikes this year, followed by 3 more hikes in 2023 and then none the following year. But with inflation in the US at a 4-decade high, experts say even this may not be enough to rein it in.
The last time when US CPI inflation stood at 7.9%, interest rates in the US were 15%. And now with this geopolitical risk, maybe interest rates should be even higher than that. But the question is, why isn't that the case? Why are they moving relatively slow? And I suspect there's 2 concerns there. One is, how strong is the economy? The other one that nobody really talks about is the debt level that we see in many of those major countries. So in the Eurozone, you have some very highly indebted countries like Italy. And it's a similar thing in the US, where also you have much, much higher sovereign debt levels than was the case in the 1980s, when there wasn't a problem to actually be putting up rates to this kind of 15% or above level. So I think not many people are aware of this very tricky situation central banks are actually in, and that they might not have as much room to maneuver and address this problem as people might think, which makes it so dangerous.
Some have expressed concern that hiking rates too fast will derail the fragile economic recovery from the pandemic. Despite the volatile and risky times ahead, though, experts say investors need to stay engaged.
In this current environment, personally, the number one reason or importance of investing is actually that not investing might also not be safe. We are looking at, in the US now, we have a consumer price inflation rate of 7.9% and an interest rate of 0.5%. Now, they're saying they will increase it further. If you're looking at market indicators of what the market is expecting, where interest rates will end up by the end of this year, it's around 2.3%, something of this nature currently. But we are still at a consumer price inflation of 7.9. So that's a very substantial negative real interest rate. And if this inflation isn't subsiding or potentially even accelerating, because 7.9 was even before the Russia crisis, which might well fuel inflationary risk going forwards.
Another source of confusion for investors is that while Western central banks are gearing up to hike interest rates, China and some other developing countries look to be easing monetary policy.
Definitely, there is a dichotomy between developed and emerging markets, and that's why in our portfolios we tend to have an overweight in emerging markets, because we believe there is a different dynamic playing there as far as liquidity and monetary policy is concerned. I also find that China is quite interesting for long-term investors, because expectations have been very muted, to say the least. In fact, some people coin the market being uninvestable. We would disagree with that. I think it pays off again to be contrarian when you are a long-term investor. And given what was announced in China by policymakers to tackle not only the monetary policy, but also to look at the different aspects of the challenges and the negative sentiment that were against China. A lot of these things have been tackled around regulatory, around Hong Kong, around ADRs. So I think we can see that policymakers in China are aware of the issues, and they are working towards a solution on each of them.
One group of investors that are watching the interest rate hikes intensely are those who invest in property. This group will be looking for practical ways to prepare for the impending hikes.
If you know that the hikes are coming, now if you are in a position to reprice or even to refinance, you should lock in the interest rate, which is low now. Let's say now it's 1.3%, right? And if the banks are willing to grant you a 2-year, 3-year fixed rate loan, you should lock it in now, knowing for a fact that possibly in 6 months, 9 months time, the rates are going to rise. So you should lock in now so that you can lock in some savings in that sense relative to the new package.
But market watchers do not expect the interest rate hikes to impact demand for property in Singapore.
Even if there's a rise of a 0.5%, 1% interest rate, people can still stomach this in terms of investment. Why? Because today the rental demand is still relatively high. So this rise in the mortgage will also be equally mitigated with the rise in the rental rates, right? So the demand is high for rentals now, and if I'm able to raise my rental, it will be able to mitigate the rise in my mortgage rates, and sometimes more. Generally, this is quite well balanced. So people have already taken this into factoring into consideration when factoring out how they make a decision in a property purchase.
So other than staying invested and being contrarian when you have a longer term horizon, what else should investors keep in mind?
Definitely, resetting expectation for your portfolio is a starting point. The second is active management. I think that the last decade we have seen a lot of flows going into passive investing because market return were quite high. So in that case, active management doesn't make really a big difference. But when market returns are lower and expected to be lower, active management makes more sense because if you are able to add 1% or 2% of alpha on top of a lower return, that the contribution is higher. And when you have high volatility also in the market, it makes sense to play with that with active management.